Thank you all for coming tonight and for giving me an excuse to get to meet the Fidelity people here. I think that our dinner gathering tonight comes at a very interesting time when all of us have had such an interesting time arguing about where China's future direction goes. Anthony has now been here a year. I am delighted that he has decided to return to active investing, and we are all the beneficiaries of that and his insights into China. Martha went to Fudan University and has been a fund manager here for many years prior to joining Fidelity. And I guess you are the youngest of the Fidelity team here, covering the consumer sector, which obviously is becoming one of the more hot ones. And I am particularly interested in what you have to say about the other countries that are part of Greater China. And for many of us, they have been much stronger performers than China itself, which is a paradox since they are the beneficiaries of growth in China. And let me start by asking you all the sort of disconnect. I mean, China as a macro story has been so compelling, and yet on a micro level, on a stock market level, its performance hasn't been nearly as consistent. I'll, like everyone else, we'll start out with Anthony to ask you, why is there that disconnect?
Yeah, it's a very interesting question. And I think in the long run, there has to be a connection between economic growth and stock market performance. A bit like with companies, I think there has to be a connection between earnings growth and company share performance. But obviously in the short term, the two can move quite differently, and it also depends on valuations. If you start at a very high valuation, you could have a long period of a stock or a market being out of touch with the underlying fundamentals. Now, the interesting thing in China, I don't think you start with a very high valuation. I think valuations are reasonable. To me,
and that's one of the compelling points that you would make
yeah,
now, right?
You know, you're not buying it when things are very high, and therefore, you know, to me, I see that the fact that it hasn't performed as well as the economy and as well as some other markets as definitely a positive for investing in China at this time.
Let me turn to you now as the person who spends their time thinking about consumption and the growth of consumption and a domestic-led economy. Does that mean the stocks that an average China fund manager would have in their portfolio today would look very different from the portfolio an average China portfolio manager would have had 5 years ago, do you think?
If you look at all the last 5 years, a lot of consumer companies, they had a very good run already. But it actually is not easy to launch a China consumer fund 5 years before. The reason is that the market, at that time, a lot of companies, they are still very small. And when you have a fund focused on China consumer, then the market liquidity is not too good. But now a lot of companies, they already grew up into 1 billion, 2 billion, 5 billion companies. So you have got quite good liquidity there to invest.
So there's critical mass now in consumer sector that
Yes.
wasn't there 5 years ago.
Yeah, I was saying now possibly you got 400 stocks you can look at, but 5 years before possibly 100 to 200. So the universe expanded hugely.
I'm just going to ask Anthony one question. Interest rates in China are still negative, especially deposit rates. Why do people talk about monetary tightening, given the fact that real interest rates are still negative? And to what extent is the fact that you're getting no money at all if you put your money on deposit a positive for the growth of the consumption story and investing in the stock market in general in China?
Yeah, I mean, it's a very interesting. I mean, the Chinese authorities typically use 3 ways to control the economy through interest rates, through reserve requirements, and then through actual quotas on lending. And it's very debatable about interest rates. Actually, some people argue because it's, there's a big deposit base in China and China consumers are under leveraged. Actually, a rising interest rate rather than dampening activity is positive for activity because people make more money on their deposits. So, but reserve requirements going up and the quotas, whether they're formal or they've stopped giving an annual quota, but they have informal quotas and by bank and by area in the bank. I think it's difficult to argue that it has a very short-term effect on other asset classes. Property may be the one that's slightly different. The consumption story, I think, is so ingrained in what the Chinese authorities want to do over the next 5 years.
As they enunciated in their 5-year plan,
yeah,
as I'm sure you all know.
I think that's such a powerful trend that I think, and I was at the Bao Forum and they were talking about, the average wage increase that everyone was going to have, at least 7%, etc. So I think that's really powerful, and this short-term tightening, I don't think will disturb that.
In your own mind, do you see a distinction between good inflationary pressures and bad inflationary pressures? By which I mean, isn't it a good thing if wages go up as long as the productivity goes up as well?
Yes, in my experience over the years, very high inflation and inflation that's sort of out of control is the worst environment. I mean, to some extent, it's always been argued to me that equities are a hedge against inflation. So some inflation is actually good for shares. Obviously, wages contribute towards inflation, so do commodities, so do food prices, etc., so do utility prices. So it's a mixture of different things. I think what you're seeing is, you're likely to see now is that some of the food areas, I think that we're past, perhaps, or passing the worst period, and they'll come down. But the wage pressures, I think, will remain there, which are good for certain things, they're bad for other things.